Investing is one of the most effective ways to build wealth, but it's not without risks. Markets fluctuate, companies fail, and global events can send even the most stable investments tumbling. However, with smart risk management strategies, you can protect your money and still grow your portfolio. This essay explores key principles of risk management and offers practical advice to safeguard your investments. Why risk management matters. Imagine an investor who puts all their savings into a single stock, only to see it collapse due to a scandal. Without diversification or safeguards, they lose everything. Risk management is about minimizing the impact of such events. It's not about avoiding risk altogether but managing it effectively to achieve your financial goals. Interesting fact. According to a 2021 study by Vanguard, portfolios with diversified investments have a 96% chance of outperforming non-diversified portfolios over 20 years. 1. Diversification. Don't put all your eggs in one basket. Diversification is the cornerstone of risk management. By spreading your investments across different asset classes, stocks, bonds, real estate, etc., industries, and geographic regions, you reduce the impact of any single loss. Example. During the 2008 financial crisis, while U.S. stocks plunged, some investors who held international equities or bonds managed to limit their losses. Pro tip. Consider exchange-traded funds, ETFs, or index funds to achieve instant diversification across hundreds of companies. 2. Understand your risk tolerance. Every investor has a different capacity to handle risk. Your risk tolerance depends on factors like your financial goals, age, income, and investment timeline. Risk profiles. 1. Aggressive. High risk, high reward, e.g., tech stocks, cryptocurrencies. 2. Moderate. Balanced approach, e.g., blue chip stocks, balanced mutual funds. 3. Conservative. Focus on safety, e.g., government bonds, savings accounts. Fact. A survey by Charles Schwab found that 70% of younger investors are willing to take more risks than older generations, prioritizing long-term growth over immediate security. 3. Have an emergency fund. An emergency fund acts as a financial cushion during tough times, preventing you from dipping into your investments. Experts recommend saving 3 to 6 months' worth of living expenses in an easily accessible account. Why it's crucial. 1. Market downturns can last months or even years. 2. Unexpected expenses like medical bills or job loss can arise. 4. Avoid emotional decisions. One of the biggest threats to investment success is emotional decision-making. Fear and greed often lead to buying high and selling low. Case study. During the COVID-19 market crash in March 2020, many investors sold their stocks in panic. Those who stayed invested saw a remarkable recovery, with the S&P 500 gaining over 70% in the following year. Solution. Stick to a long-term strategy and avoid reacting impulsively to market news. 5. Utilize stop-loss orders. Stop-loss orders automatically sell an asset when it drops to a certain price, protecting you from severe losses. Example. If you buy a stock at $100, setting a stop-loss at $90 limits your potential loss to 10%. Fun fact. Professional traders frequently use stop-loss orders to manage their portfolios during volatile trading sessions. 6. Monitor and rebalance your portfolio over time. The performance of your investments can shift, leading to an unbalanced portfolio. Regular rebalancing ensures that your asset allocation aligns with your goals and risk tolerance. Example. If your target allocation is 60% stocks and 40% bonds, but stocks grow to 75% due to a market rally, you might sell some stocks and buy bonds to restore balance. 7. Invest in knowledge. Understanding the markets, the economy, and individual investments is a powerful risk management tool. Knowledge allows you to make informed decisions and recognize potential pitfalls. Key metrics to learn. 1. Price to earnings, P/E ratio. 2. Debt to equity ratio. 3. Dividend yield. 4. Market trends. Fact. A study by Fidelity showed that investors who regularly educate themselves outperform those who don't by 2-3% annually. 8. Use dollar cost averaging. Dollar cost averaging, DCA, involves investing a fixed amount of money at regular intervals, regardless of market conditions. This strategy reduces the risk of investing a large sum at a market peak. Example. If you invest $500 monthly in an index fund, you'll buy more shares when prices are low and fewer shares when prices are high, averaging out your cost over time. 9. Beware of high fees. Fees can erode your returns over time, especially in actively managed funds. Opt for low-cost index funds or ETFs, which often have expense ratios below 0.10%. Fact: according to Morningstar, reducing your investment fees by just 1% annually can result in 28% more wealth over 30 years. 10. Stay informed about global events. Geopolitical events, natural disasters, and policy changes can have significant effects on markets. Staying informed allows you to anticipate risks and adjust your strategy accordingly. Example: in 2022, rising interest rates and inflation led to significant market volatility. Investors who diversified into commodities and inflation-protected bonds mitigated losses. Conclusion: investing without risk management is like driving without a seatbelt. While you can't eliminate all risks, these strategies, diversification, understanding your risk tolerance, using stop-loss orders, and staying informed, can significantly protect your money and increase your chances of long-term success. By implementing these principles, you'll not only safeguard your wealth but also position yourself to seize opportunities during market fluctuations. As the famous investor Benjamin Graham said, the essence of investment management is the management of risks, not the management of returns.